Hello, my name is Melissa Wybrow and welcome to IBA's latest COVID-19 crisis webinar. For this week's session, we are collaborating with SplitRock Aviation to bring you a review of the ABS market, the potential impact from COVID-19, and to provide some guidance for those of you involved on how to mitigate risk. I'm joined by Phil Seymour, IBA's president, and I'm delighted to welcome Clay Smith from SplitRock Aviation. Phil and Clay are going to be looking at current market conditions, expected trading and leasing trends for 2020, a detailed look at ABS structures, and they're going to take a look at the role of the servicer. If you have any questions, please do ping them over via control panel, and we'll look to address these at the end of the session. So let's get started. Phil, I believe you're going to kick off.
Yeah. Good afternoon from the UK, good morning or good evening, wherever you are in the world. Obviously, we're all working remotely, so I will be asking Lucy to move the slides on occasionally, so just bear with us while we go through that formal procedure. I'm going to kick off by talking about the general market, where we're at now. A couple of these slides you may have seen before if you've joined us in the previous webinars over the last couple of weeks. I'm not going to go through every one of these bullet points on the left-hand side. I think the key point with this slide, if we look at the insert, the blue insert graph on the sort of top left of the main graphic on this slide, it's really about significant numbers of potential failures. We have changed this slide a little bit because it may not be that an airline fails. There's obviously a significant amount of government support that is likely to head the airline's ways, but there is still the huge likelihood of huge numbers of aircraft returns or restructurings coming up. We've still got the point, Brent is down at about $26 today, so we've still got the low oil price, but of course that doesn't really do much to the revenue side of the equation. But we are looking at a significant amount of distress. Whether there was going to be some stress pre-COVID-19, I think there was still pressure in the airline industry, but obviously we're now into that unprecedented phase of the market. I'd like the next slide, please, Lucy. Yeah, this is really just starting to put into context ABSs and where they fit into the overall aircraft trading cycle. So as we've seen, if we look at the sold to ABS is the light blue portion of the graph. So over the last few years, we've seen a decent rise in terms of numbers of ABSs that were being put together. The 2020 estimate that we put into place was really going to reflect that the general trading is likely to be down. It's likely to be even further down now. There were 2 or 3 ABSs that had already closed, hence we do have a relatively thin slither of light blue on the 2020 estimate column. We do expect some sale leaseback activity, hence the increasing darker blue at the bottom of the column for 2020. But clearly, in terms of aircraft sold off lease and sold with leases attached, that market is going to be considerably affected. Next slide, please, Lucy. Now, in terms of leasing activity, clearly leasing is a significant part of the whole ABS proposition. In terms of where 2020 is heading, we clearly have a problem with lease start events. There could be some sale leasebacks, but that overall number of events will be down on the last few years in any case. And the big issue will be lease end events. There was already a significant amount of lease ends that were due during 2020. And of course, this crisis will only lead to a larger difference between lease starts and lease end events. Hence the red circle identifying that for the first time in over a decade, will we see a situation where there's going to be more aircraft coming off lease than starting. So I think there will be some opportunistic possibilities here with sale leasebacks as airlines look to raise cash in the coming months, but those would be qualifying then as lease starts. But overall, we're looking ahead to this year as being a pretty difficult situation for most lessors. Next slide, please, Lucy. This is a summary of let's say the top 20 ABSs in terms of where the aircraft are in the world and which airlines have most aircraft in those ABS structures. There's already been 3 deals that were launched this year, so it was on track to match the 2019 levels, but clearly that has now halted. Overall, we see the diversity remaining very high, almost 1,300 aircraft across 313 operators, but we do, expect almost all of these operators to have suffered in the current crisis. So at the time of putting these together, there was already 76 aircraft which remained unplaced. However, still a relatively low percentage, being 6%. But overall, if we look at the pie chart on the left, there are some operators there who could be classed as well. They're likely to be to get through this in some way, shape, or form. There's a few on there who may well become government owned, and there's a few there that may struggle to survive at all. But overall, I think this really shows how the ABSs have been so attractive to investors, is that overall there's a pretty good spread and lack of concentration risk amongst operators. And really the pie chart on the right mirrors that in terms of where in the world the aircraft are. So again, a good diversity in terms of country placements. And, I think this sort of shows how well the ABSs have been put together for that diversity. However, we're dealing in a different era right now. So I think I'll have the next slide, please, Lucy. And at this point, I want to introduce Clay Smith a little bit more formally. We've been working closely with Split Rock since the beginning of the year because they have some particular attributes which complement ours. So Clay, welcome to the joint webinar.
Thanks, Bill. Hello, my name is Clay Smith. I am a partner at Split Rock Aviation. We're an advisory and consulting firm made up of former senior executives of the aircraft leasing and finance industry. Please check us out at splitrockaviation.com for more information. Our quick little pitch there. As Phil mentioned, 2020 was on track to break the record set in 2019 for aircraft issuance. Just in the first 2 months, there was over $2 billion of new deals brought to market, if you count the 2 engine deals in the total as well, from Sunbird and Willis. There was probably something on the order of a dozen more deals that were setting up to enter the market, and all of those potential transactions have been shelved until further notice. If you look at the chart right now, the slide, there's 2 charts. The one on the left just represents the transactions by year. These are the actual issued amounts of debt only for commercial aircraft transactions. There was a business jet deal that we did not include in this, and no engine transactions. But these are everything that still have outstanding debt since the the fiscal crisis of 2008, 2009. On the right, you see about how much of each individual tranche is still currently outstanding. The AA tranche is kind of an unusual creature. That was only a single transaction that issued that. Generally, most modern ABS deals have 3 tranches of debt: a senior tranche that would come at an a mezzanine tranche rated BBB, and a subordinate tranche that generally would be BB. So far, we are unaware of any tranche being downgraded. Several are on downgrade watch, and we'll discuss that momentarily. But we have a little over $21 billion of ABS paper currently outstanding, representing the deals post the fiscal crisis. As you or everyone is aware, COVID-19 is having a serious impact across the travel industry. Various estimates have put up to 80% capacity cuts in airlines around the world. it seems like just a few weeks ago, we were talking about which transactions had exposure to China and other Asian carriers. Of course, now has become a completely global phenomenon. And in a slight twist, the one region of the world that's actually seen any positive signs has been Asia. McKinsey has recently estimated that there will be about a $335 billion decline in overall travel expenses, not all airline, but generally associated with COVID-19. And they estimate that this is about 6 times greater than the impact of 9/11. So as many people already understand, we need to prepare ourselves to view this industry from a completely new viewpoint, at least through the intermediate term. And where people are still struggling to understand what exactly the new world will look like once a recovery does occur. But we want to take a few moments over to discuss the current affairs of ABS and what to expect in the nearer term. I'm going to, over the course of the next couple of minutes, touch on some of the important structural issues that affect investors and some of the other things to look for in the coming months. I'm going to limit my comments to what I call third-generation transactions. These are basically the ABS transactions that have come since the fiscal crisis of 2008, 2009. There was a generation of transactions that happened before 9/11. There was another wave of issuance between 9/11 and the fiscal crisis. Then markets were shut down for several years and they reopened around 2013. 2013 and 2014 saw a few issuers into the market. Those deals have largely already been paid off and retired. And the 2015 has a few deals that are still outstanding. So ABS deals are facing many lease deferral requests from many or most of their lessees. So far, we haven't really seen any significant no-pay, slow pays coming from lessees, but we're expecting to see that ramp up significantly in the next couple of months. ABS transactions typically pay on the 15th of each month, the activity of the prior month. So March 15th saw remits that reflected activity in February. And in February, we still largely, had a fairly well-performing sector, except for a few of the Asian carriers. So we're not expecting to see any real impact of COVID-19 until April. And we're expecting to see significant declines in May. Because of the severe capacity cuts and the inability for airline lessees to continue paying their leases, S&P and Fitch have both put the sector on ratings watch negative, and we're expecting some downgrades. Depending on which epidemiologist you believe, this throttling back of air travel is anticipated to last at least months and likely into 2021. So what does that mean for us? Well, the rating agencies actually stress test the senior tranches of these deals rather harshly. In fact, sometimes by as much as 75% lessee defaults and simulated recessions to test to see if the senior notes are impaired. And they generally can survive even downturns this severe. But it's important to note, while that these notes may avoid impairment even in some rather drastic cases, they still face downgrades and repayment extensions. As many of you may know, the scheduled amortization in ABS transactions are not actually required. These are pass-through certificates. If the trust doesn't have adequate cash to pay a scheduled payment when due, that does not represent a default, but it does push out your cash flow projections as to when you anticipate being repaid. So if you're buying one of these bonds on a discount, that cash extension will have a great impact on your overall realized returns. We believe that many of the subordinate tranches of these transactions will be impaired, and we are not anticipating strong performance from equity at this time. The primary issuance market, of course, is closed for now, and we believe it will remain so for at least many months, perhaps not until 2021 will it reopen. If we look at past events, such as the fiscal crisis, the ABS market for new issuance actually closed for several years. This may be different while the impact on the airline industry is even more severe than it was during the fiscal crisis of 2008 and 2009, both in how widespread the impacts were felt and also by how deeply they were felt. We do not have the crushing liquidity crisis among certain investors that we did at that time. And there are a number of participants who are currently on the sidelines, but actually do have capital ready to deploy when and if it makes sense. People should not take too much confidence that anyone's going to swoop in and save the industry, but we do not see a chilling effect that would last several years, as happened in the last time this type of crisis came around. Trading in the secondary market for these bonds has actually been quite sparse. A few senior tranches traded last week in the mid-70s as a percentage of par, mid-70s dollar price. So these trades were pretty small, single-digit millions each. So a level at these levels, that implies sort of a mid-teens return if you assume scheduled amortization continues on track. But of course, we do not anticipate that's going to happen. If you attach more realistic cash flow extensions, then we're expecting returns for people buying at this level anywhere from the 10 to 12% range. We are not aware of any subordinate tranches trading recently, and the secondary market has also, to our knowledge, been completely closed for the last 5 days. So really what we're looking for are what we would call market capitulation trades, which have not occurred. And we don't see any impetus for them to occur in the near term. But, and I mean over the next couple of weeks, but over the next couple of months, one of two events will probably drive significant trading. That's either if funds start seeing significant redemptions, especially aviation-focused funds, or perhaps even more importantly, if downgrades start coming significantly for many of these tranches, a lot of rating-sensitive holders are going to be forced to sell. In particular, for example, insurance companies get a capital charge for their holdings that is based on the rating of the underlying debt. And that capital charge increases a little bit as an instrument goes from a single A rating down to a triple B rating, but those capital charges increase very significantly if any of these notes go over the waterfall from investment grade to non-investment grade, which would be a double B rating, in which case you'll see an increase in the number of forced sellers. We don't anticipate this, being anything, it's certainly not going to be, panic selling. There are significant pools of money, as I mentioned before, that are waiting to take advantage of this situation when it happens. But at least we'll start to see a significant reallocation among market participants of who is holding this debt once that occurs. And we currently view, given the economic considerations and risks involved, levels at their current strata to be within reason. The mid-70s. Some traders are telling us they expect paper to come a little cheaper than that. But again, we're only talking about senior tranches. In some of the lower rated tranches, particularly in the subordinate tranches, we're anticipating some significant impairments at this time in many of those transactions. And the trading levels, if and when they finally come to market, will reflect that. At the moment, we're, as often happens in times of crisis, bids fall much faster than offers do because investors don't want to crystallize losses. Investors that are not facing mark to market, especially in the senior tranches, are waiting for the market to come back, which it will if you're sufficiently patient, and they can perhaps avoid taking the serious marks. But that does mean that you're not going to necessarily see the opportunities in the secondary market in this space until some of those capitulation trades start to occur. Next slide, please. I'd like to take a little bit of time just to review how cash is distributed in a typical ABS transaction. I mentioned before that we're sort of in the third wave of ABS issuance. There was a pre-9/11 wave of issuance. There was which is we call the first wave. There was a pre-fiscal crisis wave of issuance, which we call the second wave, and then there was everything since then. I bring this up because in the previous two waves of ABS issuance, there really was no standardized structure. There was a lot of diversity in the types of ABS transactions different firms and issuers were bringing. And even among those that were fairly similar in structure, they varied quite widely in where trigger points were set for the various sorts of structural credit enhancements that are the defining characteristic of ABS. Over the last several years, these have somewhat achieved uniformity. The details still differ from deal to deal, a bit of a function on the servicer and the particular assets that make up the portfolio. But by and large, a lot of the structures within these are quite similar. What you're looking at on this slide is a highly simplified pre-default waterfall. And I simplified it out by combining or ignoring certain parts of the waterfall that rarely impact investors. Otherwise, this slide would be ridiculously busy with all of the actual buckets that sit in the waterfall. If you're unfamiliar with the term waterfall, what that refers to is every month, these ABS portfolios collect cash in the form of rents, supplemental rents, asset sales. And that represents their monthly collection, which then gets poured down. And these buckets represent the various priorities of the different claimants to that cash. So, for example, in this particular case, the pre-default waterfall, and that means exactly what it sounds, is the situation where no default has yet occurred in the trust. The first bucket, the highest priority to receive the cash to be allocated to them in the required expenses would be the servicer fees, any other professionals that were hired, trustee fees, administrator fees, those types of expenses, mostly for professionals that manage the assets. Once those expenses have been met, whatever cash is available is then made available to the Series A interest. Once that has been fully satisfied, the Series B interest, and so on. One important box to explain, because in my experience, I found a lot of people don't quite understand how this works. The maintenance support account. When maintenance reserve payers, lessees, airlines that have leased aircraft that are required to pay maintenance reserves throughout the operation of their aircraft based on utilization, those funds are commingled with regular lease rates and poured down through the waterfall. That cash is not directly reserved because it would create a tremendous cash drag and thus reduce the returns of the portfolio. And they are used to pay down the debt on the portfolio. A separate account called the maintenance support account is created to basically anticipate future maintenance expenses that will become the responsibility of the trust, usually, but not always, lessee reimbursement for maintenance that they're performing on the trust's aircraft. So what happens is the managers of the trust look forward, over the next 6-12 months, they anticipate what sort of lessee maintenance reimbursements they're going to receive and what other sorts of maintenance expenses they're going to have to incur, and start, stashing away cash now for those future expenses. And, each trust does it a little differently. There's a formula of a declining percentage. So any maintenance expense you have next month, you can save a very large percentage of that anticipated expense out of the cash flow available to you today. If you have a large expense 10 months in the future, maybe you can reserve 10% of that expense today so that you start building up a reserve. When that expense comes due, you'll have the cash to pay it. After they've paid the maintenance support, cash left over goes to pay the Series A and Series B scheduled amortizations. Now, scheduled amortization differs from a bond scheduled amortization in that it's just a guideline of what you're trying to pay if you have the cash available, but these are pass-through certificates. If no cash is available and the scheduled amortization cannot be paid when due, that is not a default. That just means that the amount of amortization, the backlog of what is owed those bonds will start to build over time if there's ever greater cash flows in the future, but it is not a default. I'll go through and discuss each one of these in a little more detail as we go through and talk about the various ways that cash gets moved around. One minor point I want to bring up quickly, the excess proceeds bucket. That's a feature of most modern ABS deals. That just means that rent that comes in from end of lease payments or lease restructuring termination fees, non-normal course of business, or at least non-normal lease rents will get paid out here to the bonds based off their priority. So that's one place where all cash isn't quite treated the same. One other point I want to bring up about this: asset dispositions are often, though not always, treated differently. So if the trust sells an aircraft, in many trusts there is a separate waterfall to distribute the cash from the sale of an asset. And again, not all trusts treat asset sales as a different type of cash, but many do. However, since we do not see any asset sales too likely in the near term, just because the market for aircraft is severely depressed, we're not addressing that here. But the overall point I want to drive home on this slide is there are basically two significant liquidity enhancers, credit enhancers for senior notes that you want to be thinking about in ABS transactions. The first one to likely get trapped is what's called the DSCR cash trap, and then there's the more severe rapid amortization. DSCR is basically a debt service coverage ratio. And you can see the formula on the left. You take essentially your monthly collections, you subtract off anticipated senior maintenance amounts, and you divide that by the Series A and B interest and scheduled amortization. So it's essentially how much cash do you have to cover your amortizations. If those fall below 1.2, and right now they're well above that for all the transactions that we follow, if they fall below 1.2, then the bucket called DSCR cash trap will capture all cash that is still remaining in the waterfall at that point. Now that cash will then be released the following month back into the collections account. So it will be available to pay required expenses, Series A and B interest, maintenance expenses, etc. It's important to realize, though, that the debt service coverage ratio is a trailing 6-month window. So right now, as trusts are checking out whether any of their cash traps have been triggered, even over the next couple of months, as we start to see serious deterioration in the performance of these portfolios, they're still going to fail to actually trigger their cash trap because it's looking back 6 months. So the cash will start to get squeezed, but you won't see a lot of it getting captured at the cash trap. Eventually, however, if it starts, when the DSCR falls below 1.2, the Series C interest and scheduled amortization, the most subordinate debt tranches, will be shut off until it has gotten that debt service coverage ratio above 1.2, typically for at least 3 months in a row. What has happened in past waves of ABS through the past crises is once the Series C gets shut off, they stay shut off, and that is often lights out for them until there's a final resolution of the portfolio. Maybe there's adequate residual value to leak out to them. The more severe event is the rapid amortization event. This will occur when the DSCR falls below 1.15 or the utilization of the portfolio is below 75%. And sometimes there's just a designated date, 5, 6, 7 years out from the time of issuance, where after that point, it's automatically assumed a rapid amortization event has occurred and will be continuing. And what a rapid amortization event is it's just at that point, all remaining cash that has survived down to that bucket will immediately be used to retire the Series A notes until they are completely retired, and then to the Series B notes until they are completely retired. And this is how I would imagine many of these ABS deals will eventually unwind over the next several years. In past waves, this is what's occurred. And the senior notes have often, generally have gotten out fine. Not always. I just want one last thing I want to bring up is one of the important things to keep in mind is that many of these events, except for an ARD or designated date, these are reversible if your utilization rates get back up over 75% or that your coverage ratio improves. You can get back to normal operations. Next slide. The events of default in ABS deals are very difficult to trigger. There's really only two important ways it can happen. There's a number of technical legal defaults, but they're fairly remote. And in even the past crises that have struck the aviation industry, the very few deals that have defaulted have essentially defaulted for one of these two reasons. And it's either that a failure to pay an outstanding balance by the final maturity of the transaction, or a failure to pay the monthly interest on the senior-most debt outstanding. It's important to understand that the final maturity is not the expected maturity. Final maturities for these transactions are typically 20 to 25 years after the issuance. So it's going to take a long time before you're going to trigger that one. And failure to pay interest, the interest on the A series alone is not a huge cash requirement vis-a-vis the ability of the portfolio to generate cash. And even in the case that the portfolio was almost entirely grounded or off lease, which I'm not anticipating, but could happen, these trusts have 9-month liquidity facilities. So even in the worst case scenarios imaginable, it would take months for a trust to default. It is important to realize, though, I've dealt with a lot of questions from people who have looked at some severely impaired ABS transactions from previous generations of ABS with the hope of buying up a lot of the bonds cheaply, which historically have frequently traded below the probable asset values of the portfolio. Hey, we could just buy up all the senior bonds. We'll take control of a portfolio that's worth twice our investment, and it'll be a great trade. In reality, that trade is almost impossible to do because the senior notes, even again, historically, we've seen cases of them trading in the 10s or the 20s, not the current generation, but previous generations, pre-crisis. And the people controlling those bonds were still unable to affect changes in the management of the portfolios. This is because until a default is actually triggered, the senior note holders do not become the controlling party of the trust, and the servicers still have very significant leeway on how the assets are managed. It's important to keep in mind that generally the way ABS transactions work is the servicer is the organization that brought the transaction to market. So they designed their servicing agreements to be very generous to them being able to maintain control of the transaction, and it's very hard to replace them or take or seize the assets in most cases. In several historic ABS defaults, you have seen managers take over, and there's even been a few cases where they were able, or people in control of the senior notes were able to take care of the portfolio, but again, that's actually quite rare. All right, next slide, please. Before I hop into this slide, I just want to kind of go over 4 factors that really drive the performance of investments in ABS. There's obviously the asset composition of the portfolio themselves, which is a topic that Phil touched upon a little. And obviously there's in times of stress like this, people are more comfortable with on-the-run narrow-body aircraft than they are with wide bodies. There's the lessee profiles, which rating agencies pay a lot of attention to. Rating profiles are very important in how the rating agencies stress cash flows and how they look at ratings, which is going to make a big difference in where your bonds actually trade in the secondary market. But again, if you're an investor in ABS already, those are all sort of baked in factors. You have what you have. Structural issues we've already talked about at some length, and that leaves the last issue that investors may still have some influence over, and it certainly requires some pretty careful focusing on, and that's the servicer. I'm pretty sure when William Shakespeare, the quote is, "The servicing's the thing." That's from Hamlet. I think he was talking about aviation servicing companies. I might be wrong on that. But in good times, it is important, you really want to look at an ABS portfolio. You want to look at its lessees and its asset composition. But what all too often happens is people don't consider the servicer and issues surrounding the servicer carefully enough. Obviously, we're now facing some pretty dire management challenges. And it's important to keep in mind what you want to see in your servicer. Good servicers have been through economic cycles. It's very concerning for those who haven't. They don't understand necessarily how to manage the absolute avalanche of work that's going to fall in their lap. There's going to be negotiated lease restructurings, premature returned aircraft just being put on the ground, extensive delinquencies. Each one of these situations on an individual plane can take very considerable resources to manage. And if it's occurring across most of your portfolio, it can be overwhelming to even well-staffed, highly experienced lessors. So on the chart in front of you, you're basically seeing the current outstanding ABS debt by servicer. So what this chart is reflecting then is it's taking all of the outstanding debt that is associated with the trust of, for example, Carlisle Aviation Partners, through, they purchased Apollo several years ago. It is a frequent market issuer of ABS. And there's nearly $3 billion of debt outstanding from the various Apollo transactions, and all the way down to VX Capital Partners that has a single transaction in the market. It's all cargo aircraft. And that debt represents the amount of outstanding debt in that one transaction. So just breaking out the various different servicers. And we broadly view servicers of 2 types. There's large general lessors that have, business, significant business, or even a majority of their business away from their ABS transactions. An obvious example would be like GCAS. They have less than $2 billion of debt outstanding in trusts they're currently managing. They have tens of billions of dollars of aircraft on lease, elsewhere. And then you have your smaller ABS-focused managers, which generally are towards the bottom of this list. These are aircraft lessors that, most or all of their assets are existing in ABS transactions. That's their principal source of funding, and they're relatively smaller and have fewer resources. Now, I want to be quick to point out here, just because an ABS servicer is small does not mean they're inexperienced. Many of these servicers are industry veterans with very considerable experience, but they do have fewer resources than are available to their much larger brethren. So when you're looking at these 2 different types of assets, you want to look at your ABS investments and look at what kind of servicer you're dealing with. Large servicers, at least comparatively speaking, are going to have the experience and staff to better handle a shock like COVID-19. And again, I can't emphasize enough the avalanche of workload that's going to be falling in their lap as they have numerous planes being put down and they have to manage through each one of those situations. The concern there for an ABS investor becomes one of focus and prioritization. If your servicer is a very large entity, they're going to have massive fires all over their portfolio, which may mean they have less, less ability to focus on your concerns. Now, a smaller ABS-focused manager is, they may only have the ABS portfolio that you're invested in, so you obviously have their full attention, but they may not have the experience or the staff to handle the situation. So you want to consider, I don't want to be in the camp of necessarily one is better than the other, but you want to look carefully at your servicer and try and understand what their capability is to manage the situation. Again, everyone's inherited the same world right now. So the real survivors, if you take the long-term view that we're going to get past this, we got past all of our crises before. It might take till 2021. Some people are saying till 2022 before we return to normalcy in the aviation markets. And frankly, the ABS transactions are going to survive. The question is what they look like after they survive, and that's going to come down to how well they can manage through these challenging times. So you want to be sure that your transactions, the servicers and your transactions, are keeping focus on what's important. With that, I will turn things back to you, Phil.
Okay, thanks very much, Clay. A very good summary there, appreciate it. And I've learned lots. I've been fielding a few questions that have come in during that time, but I will try and move along hastily. We've been running nearly 45 minutes now. So clearly one of the questions we've had already in anticipation of these slides, of course, was well, how low can values go and what's the impact on lease rates? I'm assuming that the idea of investing into an ABS was because it was seen as a long-term investment. So hopefully most investors realize this is a long-term game, so won't be panicking over the current situation. But I think it's fair to look at what's happened to lease rates and values in previous downturns. Very often appraisers are accused of oh, we shouldn't lead the market. However, I think this is an occasion where we should be providing opinion based on what we've seen in the past, and we shouldn't be putting our head in the sand in terms of, well, we haven't seen any data points yet, so therefore we're not willing to provide an opinion. I think some of us have seen several downturns in our aviation lifetimes. So really looking at this graph, the one on the top left is looking at lease rates, and this was looking at the red line is a new delivery of a 737-800 that would have taken place in the late 90s, and then we've looked at how that constant year graph looked, and there's no doubt that there were the blue is the A320, the light blue on the right hand side of that chart is the A320neo. But I want you to focus on what really happened in the I suppose it was the dot-com crash 9/11 that then led into the SARS period. So the early 2000s were a pretty rough patch that embraced several mini issues, and clearly we're now dealing with a global issue. So I think we need to look at these in the context of how low things went at the time, and it was apparent that for new aircraft deliveries at that time that there was some drop off in the lease rates that were achieved, because there was obviously overcapacity. Airlines were having a tough time, and clearly the negotiating position was such that the lease rates dropped. I suppose it is important to, we have overlaid the 5-year swap rates as well, because there tends to be a reasonable correlation between interest rates and lease rates, not always fully linked, but a reasonable sign. So it did take a while before lease rates got back to their sort of pre-crisis levels, but then there was a rapid swing upwards as growth exceeded availability in the market. Looking across at the lower right, this is looking at the lease rates for 10-year constant age of aircraft, and here, of course, it was probably didn't come into the later recession with the 737s. Once they got to 10 years in the late 2000s, you could see how there was a drop off when we went into the global financial crisis or Great Recession, whichever is your preference for describing that. So it is apparent that there are drops in lease rates, and for the more liquid aircraft, that drop can be maybe 10, 20, 30%, and there are some positive recoveries once we come through what is seen as the dip into the growth phase. Next graph, please. Next slide, please. Yeah, in terms of market value to base value relationships, because I know a lot of these ABSs would have initially focused on these metrics. This is an example of what was then a 1998 vintage 737-800 and A320 CEO, as we went in from the late 90s into the 2000s and then into the post 9/11 dip. And there was a drop just greater than 10% from base value in what we saw as market values for that vintage of aircraft. But again, there was recovery. However, for older types of aircraft, we did see drops that exceeded 30%. And clearly, you know, with the news in the recent days, likes of American saying that the fleets that we already knew were likely to be retired or passed on, some of the older 737NGs, 757s and 767s, that will clearly accelerate those retirements, and typically very few of those will come back into operation. There may be a few cargo conversions on some of those, but basically time is going to be up for the majority of those aircraft in our opinion. Next slide, please. Yeah, I won't go into too much detail on here. I'll leave you to take some of these away, but again, this is looking at the typical sort of depreciation curves. On the left, we have the wide body market value performance, selection of narrow bodies, and then the regional and turboprop selection. As we can see, a aircraft that was delivered in 1998 kind of followed the economic cycle as well. It was depreciating anyway going into the 9/11 period, and then took more of a dip. There was some recovery there, as you can see. The 747-400 freighters at the time did recover quite well, but then sort of underperformed overall. So I think these are the types of values and values curves that we'll be looking at pushing out in the coming weeks, because we're obviously being asked a lot about how these are likely to vary from our expectations, but also in absolute terms what this potential glut of aircraft availability will do to market values. It does seem as if there's very few sectors that have been unaffected. There's obviously been a pickup in some of the freight movements. It remains to be seen whether that uptick will be sustainable. Clearly, a lot of that demand has been because of the lack of passenger aircraft belly capacity. As that comes back in, it'll be interesting to see whether that the initial uptick in freight demand will be sustainable. Next slide, please. And sorry, yeah, this is the lease rate performance. The previous slide was looking at the market values. Again, I won't go into too much detail here. I think they're self-explanatory. Obviously, welcome to take some more questions, but I am keen to get on to the question phase. So the next slide, please. Yeah, in summary, we've got a situation where obviously aviation ABSs are on negative watch at S&P and Fitch. Downgrades are expected. We're awaiting Moody's and Kroll, of course, very shortly to see what they come up with. Subordinate debt tranches may experience losses and senior tranches will extend, but overall ABS deals are unlikely to default. We're advising investors to focus on the services organisation and ability to handle additional workload from early returns, lease structurings and remarketing. Like a lot of these things, the devil is going to be in the detail. A myriad of airlines and different aircraft types, different lease terms, and all of these will probably be up for grabs. In terms of the macroeconomics, we're given IATA's recent announcement, we're not expecting a market recovery to be V-shaped. There's lots of talk, is it going to be a U, is it going to be an L? I think at the moment what we're really saying is it's probably too early to tell, but the V seems to be what was the most optimistic view perhaps at the beginning of February, but now that this is more global and we've got a longer period as this spreads around the world, we don't think a V shape is likely to be seen. As we've mentioned there, we do see lease rates and values will be softening, and interestingly, probably across all types. There's no sector that seems to be untouched by this COVID-19 impact on aviation. So in terms of looking at reviews of leases, I think this leads into one of the questions that's come up. And Clay, I don't know if you've got to give us a quick summary of this. Is how is a typical ABS structured from an oversight perspective? How is an ABS board structured? Is it truly independent from the servicer? Because I think that's going to be a question on many investors' minds. Is there a short response you can give to that?
Sure. And if people want to, by the way, if any of these questions, if you have questions we don't get to or you want more detail, please feel free to contact us and we can more fulsomely answer your question. But generally, the boards of ABS transactions, which are set up by 2 independents and 1 equity appointed board members, at least that's the vast majority of them, they have, their fiduciary duty are to the investors in the trust, not to the structurer. And because of that, those boards do have generally a lot of independence. I haven't seen them being, too captive to servicers. But what really gives the servicer a lot of control over these situations is the servicing agreements. Barring fairly extreme situations, it is hard or impossible to remove or substitute a servicer. There is a lot of times that major decisions have to come from the board, and there are a lot of times where the board will give guidance or direction to the servicer, which they will be required to follow. But at the end of the day, in my personal experience, with a lot of these ABS transactions, the boards fairly represent the interests of their investors within their power to do so.
Okay, thanks, Clay. Another question: has there been any trading of e-notes? Is that something that's happened?
If there has been any trades in any e-notes, we are unaware of them. I'd be a little surprised. I mean, since the crisis, I'd be a little surprised if that has occurred. Fair
enough. In terms of I think we touched on these points about servicer, and we've had a few questions that have sort of circling back on that in terms of the amount of workload that lessors are going to have on their plate now. This isn't just a few aircraft. This is a significant number, if not all of their fleets, that are going to be affected. So I think it sort of comes back to this point of will the servicer properly be able to serve the ABS? Will it be seen as sort of a fait accompli that's been given to the ABS the ABS boards? Will they have any ability to push back on what a servicer recommends?
Well, boards definitely can push back on what a servicer recommends. Again, the boards of these trusts do represent the fiduciary duty of their investors. And while obviously the creation of these trusts were, basically creations of the servicers themselves, we've seen in the last couple crises, the boards function the way they're supposed to, which is to represent their bondholders and their equity investors. However, their freedom to push the servicer to do certain behaviors can be limited based off that servicing agreement. And at the end of the day, we do think that we're not anticipating any conflict at the board level, but there may be times when the servicer is not performing the actions that bondholders would like to see. And that is definitely something that we have seen in previous crises from past generation transactions.
Okay, I don't know if this puts you on the spot a bit. We've had a few questions around a similar situation about concerns about large wide-body aircraft. Do you know if there are any of these ABSs that are particularly exposed to wide bodies, or have they been reasonably well balanced?
I'd probably choose not to call out transactions by name. I mean, it's largely public information, but I do think that the questioner is on the right track. That wide body exposure definitely represents a vulnerability in the asset composition. Remember, there are four main factors to consider when you're looking at ABS. And that is only one of them, but it's obviously a very significant one, because even in the complete collapse of your lessee portfolio, that's what you're looking to for your ultimate payout. And some of the more exposed to transactions have up close to 40% exposure. So I would definitely want to consider that carefully if I were an investor.
Sure. Look, I think we're coming up to the hour, so the questions that have been asked, we may have addressed some of those in the last few minutes, but we will get back, either combination myself and Clay will get back to each of the questions that have been asked. So at this point, I want to hand back to Mel.
Thanks, Phil, and thank you to both yourself and Clay. I think that was very useful and interesting insight there. I've just got a couple of messages before we wind up. I just want to highlight that the data used in today's session is from our data intelligence platform, IBAIQ. For those of you that haven't had a look at the system yet, we are offering free trials, and they are available to register for through our website. And that just leaves me really to say thank you again to Phil and Clay, and thank you all for attending today's session. As Phil mentioned, we'll be sending out a copy of the slides and the recording in the next day or so. Our next session, we'll be looking at the impact on aircraft values and lease rates, again in a bit more detail than we have done today, sort of a deeper dive on that. Details of that session will be coming out early next week, so please do keep an eye out for that. So on behalf of IBA, Clay and SplitRock Aviation and myself, thank you for joining us today, and goodbye.